All right. What is up, tycoons? What's up, traders? We have to talk about the stock market crashing. All right. Now, what's crazy is that we have one of the largest perma bulls, Tom Lee, is warning that investors should brace for an August stock market slump. Now, we're going to discuss why that is. We're also going to go over some seasonal data and just take a look at the data in general that really supports this. So be sure to smash the like button, subscribe to the channel if you guys are new. Lots of great content in today's video. Now, stocks could sink into a bear market recession, says technician, and here are 5 signals on when it likely starts. So we're seeing all these bearish headlines, right? And these were both on July 31st after market, and now the market is crashing, okay? Largely due to the Fitch credit downgrade. We'll go into that in a future video here shortly. But I really want to cover this. This is the August market performance related to pre-election years. And now this is very important because this type of seasonal data and cyclical data has been really, really helpful, right? It actually helped call the bottom in October for the S&P 500. I went over that a lot, back in those days. I was showing the midterm election year shows that 6 months and 1 year out from the end of the midterms and when the midterms happen, the stock market historically has been 100% green or green 100% of the time. Now we're in that pre-election year data. And so we're looking at a lot of that. And we can see that in August, right? All of the dotted lines, those are going to be your pre-election years. All right. The dotted lines are now the NASDAQ is in blue, the S&P is in green. And what do we see here? We see that the beginning of the month typically results in negative returns. Okay, you start to see negative returns. The NASDAQ is down over 2% at the time of this recording. And in the first 6 trading days is really when we start to see, lots of pain in the market in August via this historical data. Now, it does start to kind of pick up here in a little bit, and it's not going to exactly follow this. All right. If it was, we're already way past that. We're already down 2% in the NASDAQ. Remember, that's the blue one just today alone, largely due to that Fitch credit downgrade. But you can kind of use this stuff as a little bit of a supporting thesis for some of your investment ideas, right? And this is some stuff that I really like to look at a lot. Now, of course, the content provided on this channel is for informational and educational purposes only. It is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the full disclaimer. You can always email me as well anytime for one-on-one personal coaching sessions if you're interested. I do those every week. ZachlyTrades@gmail.com. Today's video is sponsored by Simply Wall Street. It's a really amazing platform. You guys are going to be able to get awesome news, stay up to date on the market and your favorite stocks. And if you're not a pro at fundamental analysis, they have their pros doing the work for you. And you can go and search up your favorite stocks you own, some stocks that you want to own, or you can look at the market by individual sectors, which is really important to do sometimes. So you can see kind of what sectors are lagging behind, what sectors are overvalued, and what sectors are undervalued. There's a link in the description for a 14-day free trial. You can go ahead and use that link. You also get up to 40% off for the first 100 people that join. Now, investors should brace for an August stock market slump. Fundstrat's Tom Lee warns. Now, we just looked at that August data right there, and we see that during pre-election years, historically, the market does sell off in the very beginning of the month. Now, to support his case, Lee rattled off a batch of performance factoids. Now, we're going to go over these. I'll underline them for you. But since 1950, the average return for the month of August has been just 0.01%, making it one of the worst months for stock market returns. And during that period, the win ratio for the month has only been 55%. So not good statistics there, right? And when stocks fall in August, the average drawdown is 3.2%. That would imply roughly 150 points of downside for the S&P 500. Now, another interesting caveat is stock market underperformance in August worsens when the S&P 500 has gained more than 15% through the end of July, which is what we're seeing right now. Okay, your average return falls to negative 1.4%. So it's not that 0.01%, it's actually negative 1.4%. And also what's even crazier is the S&P 500's win ratio declines to 40% and the average drawdown swells to negative 3.5%. Now, if you've been a fan of the channel and you've been watching the videos, we've been kind of going over this pre-election data and just showing that, hey, July is typically a really good month. And then we start to see a sell-off in August and September. Now, we'll dive more into September and go over their data when September comes. But this is some of the important data. And A lot of times price action precedes news. And so what we're seeing is that, in the last video, one of my last videos, we kind of went over how the market was already setting up to go risk off, right? That was back in the end of July. We dropped that video and we showed you guys, how the market was setting up to go risk off. And now we get the big Fitch downgrade in the credit. And that's really dropping the market a lot today. Now, the good news about all of this is that hedges, right, which are basically put options, the cost of buying a put has fallen to the lowest level on record, right? And you can see that right down here. This is via Bloomberg, and this is the S&P 500 index cost of a 95% 1-year put. So, if you do want to hedge yourself, all right, you don't have to, but if you want to hedge yourself with some put options on the S&P 500, right? They are cheap right now. Now, the cost of them have gone up after this really red day, but still, when you take a look at the past and you take a look at some of the extremely elevated levels that they've been at, they're still relatively cheap. So if you do want to hedge your portfolio for maybe some drawback in, September, August, it's still a cheap time to do so. This is that August market performance. And again, we can see here, right, during the pre-election years and the dotted lines, you see that the first 6 trading days are not very good for the market. I mean, really about the first 10. Okay. Now, these are not calendar days. These are trading days. So how many days that the market is open for trade. So keep that in mind, right? This isn't going to mean August 6th. This is going to be the 6th trading day of August. Now, there's been a surging demand for calls, all right? Net call volume jumps to the highest level since late 2021, and we know that that's around when the market crashed. And you can see we have these surging call volumes. We've seen short squeezes, we've seen gamma squeezes all over the market. You can pretty much pick a stock and there's been a short squeeze in it. You look at a stock like LIDR, this is LIDAR. You look at a stock like SDC, Smile Direct Club. You look at ticker symbol YELL, the yellow company, I believe. All right, they just announced bankruptcy and the stock went up basically 1,000%. It was at 43 cents last week and it hit highs of $5 just yesterday. So there's been squeezes all over. We've seen it in the cannabis section as well. TLRY, we have a couple members in the Discord that actually got in early before the entire squeeze happened with some options, and they were up hundreds and hundreds of percent. So it's really nice to see that stuff and see people making these profits. But a lot of times when you start to see these short squeezes happening and the real market isn't moving, meaning the S&P and the QQQ SPY and QQQ are not moving and making new highs and are really either flat or down, oftentimes that's a very, congruent topping signal, right? Because you're seeing a lot of the meme stocks and a lot of the short squeeze stocks happening, but you're not really seeing any follow through in the big names. And, of course, now we're seeing the market pull back. Now, this is the Fed's liquidity program, okay? And you can see the SPY here in green and then their liquidity program. And as this has gone up, right, this started here in March, right? And as this has gone up, it's added liquidity to the markets and to the economy. And a lot of that money has flowed into the big names, right? Microsoft, Apple, NVIDIA, Google. And that's largely been a reason driving the S&P 500 up. Now, it's not the only reason, but that's been one of the reasons. And as they continue to do that, it wouldn't surprise me if we do see markets continue to go higher. But, when we keep in mind of, a time cycle and so a little bit of seasonality, maybe we won't see those gains or really big gains in August and September. And the odds are increasing more that we could see, a little bit of red during these months. Now, when you look at institutional client flows, all right, they flip negative. And or this is the institutional clients, the flows that have flipped negative. You can see a large spike in this right here. Okay, so it's a little bit hard to see, but there is a spike right here. So we're seeing a big spike in the flows flipping negative. When you look at the 4-week average trend cycle or average trends by client type, and they've been net buyers since March. So they have been buying up since March. And maybe now we start to see a lot of this, cool down a little bit. When you look at the flows flipping positive for private clients, all right, so flows flipping positive, you can see that there's been a sharp decline in this. So we're seeing, a sharp rise in the flows flipping negative, and then we're seeing a sharp decline in the flows flipping positive, right? And this is for institutional clients and private clients that we're seeing this, that really, we're just starting to see some people pulling money out of the market, essentially. Now, when you look at the equal weight market, okay, this is the equal weight sector returns in the first half of 2023. It looks a lot different than the second half, right? And this is the second half right here. So you can see RSPG is down here. It's the third from the bottom. Over here, RSPG is actually leading. All right. Then we have RSPF and RSPM. All right. And where do we see those at? We see RSPM down here, and then we see RSPF at the very bottom. So, a lot of the laggards, right? And this is, remember, this is equal weighted sector returns. So a lot of the lagging sectors from the first half of the year, we're starting to see those become some of the leaders already here in the second half. And I definitely think that that's something that can continue, right? We can see we'll take a look at some charts here in a second, but we could be seeing a lot of the things that were lagging behind continue to start to outperform some of these other major sectors that have really outperformed in the first half of the year. All right. Another thing that can help drive stocks lower is going to be the US dollar rising. Okay. If the US dollar, you can see that they're both pretty much negatively correlated with each other. So the S&P is going down when the dollar is going up. The S&P bottoms here when the dollar tops out. And then this is in a downtrend. This is in an uptrend. The big question right now is, are we going to continue this downtrend on the dollar and continue the uptrend on the S&P 500? Or if we see the dollar break out here, right? And let's just draw a little rough trend line, okay? If we start to see the dollar break out, could that result in a short-term top for stocks and we start to see a pullback back down lower? That's something you want to consider and pay attention to, is going to be your dollar. Now, this is the chart that we showed last video, going over some of the signs of a risk-off market. And now we're really starting to see that, right? So we have the S&P 500 in orange. We have XLY divided by XLP. This is going to be your consumer discretionary versus consumer staples. And back in July, before July even ended, we saw a sharp sell-off in this, all right? So basically, when you see XLY divided by XLP go up, again, your discretionaries to staples ratio, when this is going up, this basically shows you that, the market is in more of a risk on environment. Okay. And you can see that this chart pairs up very well to the actual S&P 500 itself. And what do we end up seeing down here? This is the XBI. This is the biotech sector of the market, which to me is the most risk-on sector out of all of the sectors, because many times these biotech companies are unprofitable companies that people are investing in, hoping that they pass clinical trials or, get some type of drug or cure for something. And oftentimes they're unprofitable until they can accomplish that goal. And once they accomplish that goal, then they actually become profitable companies. And so what do we see? We saw a big decline here in the discretionary to staples. We saw lower highs here in the XBI. All right, but meanwhile, the S&P 500 itself was still continuing to go up higher at this moment. So that was a clear sign that, hey, the market is starting to go risk off. What are some of the reasons of that? And as we mentioned before in the video, price action oftentimes precedes the news. And now today we have the big news about the Fitch credit downgrade, and that's what's really dropping the market a lot today. This is XLF divided by XLK. So this is going to be your financials divided by tech. And it's at a critical area right here. Okay. So this is basically when this goes down, financials are underperforming tech. And so we talked about some of the other sectors that have been lagging, right? You can clearly see that this has been lagging. It broke through the 2020 lows. And maybe financials are potentially a sector where money could flow into. Right now, it doesn't have to. This is just something that we're potentially looking at. We're going to see, are we going to get a huge breakdown here, or potentially could we start to see tech or financials outperform the tech industry a little bit if we start to see a sell-off in some of these really, really big tech names? This is the XLF divided by the SPY, the financials divided by the market, essentially. And you can see that it's trying to put in a bottom here, right? So we have this prior level we tested as support many times. Now we flipped it to resistance over here. And we're going to see potentially, is it time for this to rally back up and test this zone again? And most likely we would get a rejection there. Or is this going to continue making a downtrend, right? If we take a look at the next one, this is XLE divided by XLK. So this is your energy divided by tech, all right? And we can see, we have the zone over here, prior resistance becomes new support twice, 3 times now. And we could be potentially putting in a giant cup and handle right here. So that's going to be interesting to see how it develops, right? Is energy going to actually start outperforming tech? This is XLE divided by SPY. So this is your energy, essentially divided by the market right here. And, we have the prior resistance over here becomes new support, becomes new support. Is energy sector about to start outperforming the market after reaching the level that we were looking for, right? We're potentially looking to see if we're going to get a new five-wave structure that could take us and really show an example where energy really starts to outperform the market. We've seen a big spike in energy prices here recently. I'm sure you noticed that at your gas pump, within the past few weeks. You can see that really, really big spike. Gas went from around my house around 309 all the way up to 379 in a very short amount of time. So we'll see if that starts to reflect, into some of these stock prices later on in the year during the second half of the year. Now, that's pretty much it for today's video. Hopefully you guys enjoyed it. If you did, smash that like button, subscribe to the channel for more. I do videos like this every single week. And yeah, that's it.